Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. It's another episode in our series, The Road Ahead. We're picking the brains of some of the smartest folks we know to find out what they're looking at as the new year unfolds. Today, we'll talk to a former insider at the Federal Reserve to get some ideas about the economy, the financial system, and lots more on the Real Estate Guys radio program. As real estate investors, it's no secret that the real estate guys love Florida, and the Sunshine State continues to receive more than its fair share of businesses and population relocating from the Northeast, which has created a huge opportunity for real estate investors. So come join Russ and me in mid-August for our Jacksonville, Palm Coast, Ocala field trip. On this highly interactive trip, you'll get an up-close, hands-on, personal experience you'd be hard-pressed to find elsewhere. You'll feel the vibrancy of the markets, observe the quality of the infrastructure, and truly get a sense for the demographics, all things you just can't do by simply searching online. Plus, we'll introduce you to our Boots on the Ground team, and you'll meet some amazing investors from all over. To reserve your spot, go to realestateguysradio.com and click Events, where you'll find the Jacksonville Field Trip. There's a big difference between researching a market from afar and seeing it with your own eyes. So join the Real Estate Guys as we explore not one, but 3 amazing real estate markets. Go to realestateguysradio.com and click Events for the Jacksonville, Palm Coast, Ocala field trip. See you there. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Hey, look who's in the co-host seat, our financial strategist, Russell Gray.
Hey, Robert.
We are having a great time getting to pick the brains of people we love and admire in our series here, The Road Ahead. And today, we've got a special treat for you because our guest always makes a splash on the Real Estate Guys. She's not typically thought of in terms of the real estate side of things, except like many folks who are out there looking at the economy and all the indicators, she dives probably more into real estate than a lot of folks do.
Yeah, well, she comes from the Federal Reserve, and the Federal Reserve is the giant gorilla in the economic room. And everybody hangs on what the Fed does. And if you're a real estate investor and you don't pay attention to the Fed, that just means you haven't been doing it that long. Because at the end of the day, the Fed is the driver of what interest rates are. And if you're doing real estate, you're using mortgages, and things like the 10 and 30-year bond matter to you, the yield curve and what it means to indicating the health of the economy and job creation. These are all the things that our guest lives in and talks about. And they have direct ramifications on employment, wages, cost of living, discretionary incomes, interest rates, availability of credit. The Fed is a big player. Understanding the Fed is a very important part of being a successful real estate investor. It's something we've been talking about here for a dozen years now, since the great financial crisis, where we found out how painful it is to be ignorant of what goes on in the stratosphere of the financial system, because it does roll downhill onto Main Street sometimes, and particularly on the debt side. And the bond market right now, I mean, you know, we've got interest rates rising for the first time in a long time. Mortgage interest rates have been rising. Is that trend going to continue? We don't know. We've got exacerbations in supply chain and the cost of materials going into housing, and more upward pressure in pricing. We've got the energy issue. There's a lot of things to be paying attention to and to talk about today.
Nearly every guest we've had on the road ahead has talked about the Federal Reserve, so I think that's just kind of food for thought. We're not going to dwell there, even though arguably today's guest has the highest pedigree when it comes to actually having earned an opinion about it, but it'll be interesting to see what she says. But I think big picture is this: the market is changing, and the market always changes. In the last couple of years, this astronomical, incredible change has been not just because of the pandemic, but I would argue even more so the reaction to the pandemic, all of which is outside of your hands as an individual real estate investor. So what you have to do is look at the big macro picture and then decide, okay, for the markets I'm in, the product types I'm in, the places I'm thinking about deploying capital, what makes the most sense? Nobody has a crystal ball. Nobody knows exactly where you should invest or what you should invest in, not even you. But what you can do is open up your mind and your ears a little bit so you start to see the patterns. I mean, I've watched you, Russ, really become self-taught in this area. When we first met, we didn't have too many conversations about the Fed, but it's not long as a real estate investor before you realize, hey, you know what? What they do affects me.
Well, yeah, and what the government does too. So you've got two different policies. You've got fiscal policy, which is what the government does in terms of its spending. And obviously, we've seen stimulus and infrastructure bills, and it doesn't matter whether it's Republicans or Democrats or whatever. I mean, those are the two basic flavors today, but everybody in government spends money. And when the economy starts to show some weakness, they spend more money as a way to stimulate it. The other side of it is the monetary stimulus. And this is what the Federal Reserve does with things like quantitative easing, lowering interest rates, printing more money, purchasing bonds, purchasing mortgage-backed securities, which is a direct pipeline of freshly printed Federal Reserve money going into real estate. And it creates a lot of the equity many real estate investors on Main Street are enjoying. So the interconnectivity between the government and the Federal Reserve, and the Federal Reserve is not part of the government. It kind of is quasi. I mean, I won't go into that whole thing, but a lot of people think it's a federal agency. It is not. It's a network of independent banks. But there's an interconnectivity in policymaking, both on the government side with spending and the Federal Reserve on the money side, that conspire together, if I can use that word, to affect the environment we live in. And when you compound that with the policies that affected employment, business operation, evictions, and so on in the COVID response, which also affected supply chains, there's just no way that we can sit here and host a real estate show and not talk about these things. It's controversial, right? We got some pushback on our first episode with Chris Martenson because Chris had some controversial opinions on the accuracy and maybe even the motives behind the science that affected the policies. But at the end of the day, we had to hear what he had to say because these policies affected real estate investors directly. It's not some disconnected thing. It was very direct. Businesses being closed, evictions, moratoriums where you couldn't evict non-paying tenants. And there was a big contrast you could see in how certain government philosophies, the way a government operated at state level, one state versus another state, and that created a big trigger of migration patterns and people moving, and that affected real estate markets. So, you have to pay attention to this stuff. And when we invite our guests to come on and speak, we invite them on because we think they're qualified to have an opinion. And we let them talk. We want to hear what they have to say. And sometimes we agree, sometimes we don't, but we want to hear what they have to say because they've earned the right to have an opinion. And all of this stuff does matter on Main Street, and that's why we pay attention.
Well, I'm glad you brought that up because so many times people view whatever it is through their political, personal lens. And listen, we're agnostic when it comes to all that. And you can be a dyed-in-the-wool, supporter of whatever side you're interested in. But you have to also be enough of a student to set your opinion aside first and then hear what other people have to say. And then you can decide, okay, do I agree? Do I disagree? It's what Stephen Covey talks about in the 7 Habits of Highly Effective People. You have to seek first to understand and then be understood. And I think the pushback you're talking about is when people are so dogmatically committed to their own opinion that they can't hear other voices. And it's hard. It is hard, but you really do have to listen to, as we would say, both sides of the coin, and recognize, as our friend Robert Kiyosaki says, that there's a third side of the coin, the edge. And if you can stand on that edge and consider both sides, then you make the decision that's right for you. And speaking of earning an opinion, Danielle DiMartino Booth is our guest today. She's worked in the public and private sectors. She's probably best known for spending 9 years at the Federal Reserve Bank of Dallas, where she served as an advisor to President Richard Fisher throughout the financial crisis, and followed up with a book called Fed Up, an insider's take on why the Federal Reserve is bad for America. So you probably know her opinion already. What you're going to love is the details and the nuances that she'll bring to light when we come back. Danielle DiMartino Booth on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Self-storage is an asset class that has stood the test of time. Going into the Great Recession of 2008, self-storage had the least negative impact of any of its commercial real estate peers, and it had explosive growth coming out of that time during the recovery. Fast forward to 2020, and you'll see that same pattern during some of the worst part of the pandemic. Hi, my name is Dave Zook, founder and CEO of The Real Asset Investor. Our operating partners are some of the best in the business, and we've had great success over the last decade buying mom and pop operated self-storage facilities and taking them to the next level by forcing value through increasing the square footage, adding climate-controlled units, bringing in our professional management teams, and turning the project into an institutional target. We have self-storage investment opportunities available for accredited investors who are interested in investing in this space for cash flow, tax impact, and huge equity appreciation. Reach out to us today at selfstorage@realestateguysradio.com.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com or look under the events tab at realestateguysradio.com.
Hi, this is Anthony Melchiori from Hotel Impossible, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Now in our 26th year of broadcast, it's our Road Ahead series. We're wrapping up it with a fabulous guest who pays a lot of attention to what happens in the economy, in the real estate markets. Please welcome back to the Real Estate Guys radio program, Danielle DiMartino Booth. Hey, Danielle.
It is great to be back with you. How are you?
I'm great. It's always great to have you on the program. There's a lot of folks who study the stuff you do, but I love the fact that you pay attention to all kinds of different metrics and so forth. And before we're done, we'll tell listeners how they can get a hold of your continuing intelligence. But share with us this. We're here, just kind of out of the gate, first couple months in a new year, and it's a crazy year already. Surprisingly, a lot of folks have had a better than they expected 2021, but there's a lot of uncertainty. There's a lot going on. What are the primary things you're paying attention to right now, Danielle?
Well, as you rightly observed, there are a lot of moving pieces in 2022 that were stationary in 2021.
Yeah.
And, we had the rental eviction moratorium, for example. We had that last through technically October because all landlords were made to give at least 1 month's grace. So from September the 30th to Halloween.
Yep.
And then you had a large number of states extend the moratorium through mid-2022. You had a lot of landlords who saw that the holidays were coming and waited. So now we're finally starting to see the first few waves of evictions come back through. So the eviction rate is beginning to normalize on the multifamily side. If you add up everything that's coming online, single family homes under construction, you've got more than you've had anytime since 1974, when the boomers were just breaking out and having kids. And you've got more multifamily coming online. You've got record numbers of multifamily units that are coming online in 2022 and into 2023. So you have to ask yourself, given what we can see in front of us, which appears to be a slowing in the economy, where there is not going to be any more stimulus checks, fiscal stimulus checks. People don't have as much discretionary income as they once did. We saw Weber Grills, for example, come in way below expectations on its earnings report. Not only is it not selling as many grills as it once did, when we were all cooped up during COVID, but its input costs are also costing it more as well. One heck of a margin squeeze. And I think you're going to see more of that increasingly, especially in real estate, because input costs matter there as well. And, when you have an entire generation of younger people, and we're talking about millions of people who have fallen out of the workforce, especially in the younger cohorts, they're going to take a long time to get back into the pipeline of purchasing first-time home buyers. if they've been in mom and dad's house.
Yeah, you bet. And in fact, I think the very mindset, folks in our age group, we remember it being the American dream that one day we didn't want to rent, but we wanted to own. And I don't know that that's even true anymore. People are looking at alternatives to that. Why would I want to be invested in one location and one property when I can share with my friends and take on roommates and rent out a room from a place I rent and all those kinds of different thinking. But I also think, we've seen everybody appreciate the fact that their houses are up in value. And it's kind of across the board. But then it's no surprise with the trillions of dollars that have been printed. And to your point, we are seeing that start to cool down. But it's not that prices are going down yet. It's just that the rate they're increasing seems to be going down. Is that what you see?
Yes, you're starting to see, especially luxury, hit a wall. I've got friends in late 2020 and 2021. You would just have knockdown, drag out bidding wars, anything that was, a suburb of New York City. So I've got friends in Greenwich, and they just took slightly less than what was listed. It turned inside of about 6 weeks. So it didn't, go very quickly, but that was telling to me because, when you think about certain markets that were just magnets in a post-COVID world, and on top of that, I'm good friends with Ivy Zellman, and she does great research on second home purchases, and we've seen that turn as well. And overarching all of this, heading into 2022, investors were 26% of all transactions. Now they're north of 30% of all transactions, and it's very difficult to glean out fundamental trends in real estate when you have so many price agnostic buyers in the market, and they're agnostic because they're playing with somebody else's money.
Yeah. And then you've got the fact that if the bidding wars stop, now we get back to a much more normalized market where they're going to find their price, right? You talk a lot about price discovery, and it is interesting to watch. And yet we've known for a long time there's been a shortage, a housing shortage, looming because we haven't been building as much. Some of it is the shutdown. Some of it is the supply cost, obviously, and prices of lumber and all that, but that's starting to ease up a little bit. What about the supply chain side? Are you seeing any breakup of those log jams?
I think we are seeing, we're starting to see cars back on lots. We saw in January for the first time, new car prices come down. So that's definitely a very first.
Yeah.
A very, very first. But again, we have to appreciate the idea of demand having been pulled forward, especially with the millennials who they sprang out for the first time and bought a home in the post-pandemic era. A lot of them are discovering that buying a home is not the same economically as owning a home.
Yeah.
So maintenance costs, the things that we're so old, we're like, oh yeah, wait till your first property tax bill comes. we know this like the back of our hands. But this younger generation, especially if they're buying an existing home and not a new home, they're like, what do you mean an HVAC system? What do you mean 2 units went out in August and it's $10,000? What are you talking about? That's a huge number. So I think that there's some amount of buyer's remorse. And to your first point that you made, there's a strange nihilism with the youngest individuals who, they're like, well, I can rent a 1-bedroom for about the same price I can rent a 2-bedroom. And it looks like I'll never be able to buy a house. And that's a separate trend we're seeing emerging. There are a lot of roommates. There's a big increase in renting roommates. And so many of these multifamilies that have been constructed are luxury. So they've got to hit a bogey for that 1-bedroom. No matter what happens, they have to hit a bogey for their internal rate of return to work. That's what happens in a world of 2.5% cap rates, period, end. But once you step up the ladder a little bit to a 2-bedroom, all of a sudden 2 people are like, we can keep having our experiential lifestyle where we get to travel everywhere we want and buy the latest iPhone and not have to make a commitment to buying a home. And so it's an interesting demographic dynamic. And this is with, if you add up the 25 to 34, 35 to 44, and then the 55 pluses, that's against a backdrop of 5 million people who've dropped out of the workforce, who really don't have the wherewithal, therefore, to pay for a down payment. So all of these things I'm describing would suggest to you kind of an arresting in housing activity, but then you have the investors. and they create this massive amount of noise.
Well, and that is a great distinction, those number of transactions. And I was going to ask you about car sales because you always seem to have your thumb on that pulse. And last time we talked, we were in the front of just no supply and lots were empty and there weren't enough chips and so forth. So that seems like a turn. What about the used car side? Has that changed at all because of demand or pent up demand?
So we're also finally seeing our first month of, and the decrease has increased. The pace of decrease has increased as January came to an end in terms of used car prices declining.
Okay.
And these are all very, or at least they should be very intuitive because we do have people returning to urban centers. The exodus to the exurbs is over. Now, Omicron may have convinced some employers, no doubt, that work from home was just going to become a new way of life for the corporation. That gets us into the whole discussion of what's going to happen with office properties in 2022. And that's huge. We write about this subject constantly because there's a spillover effect from offices, which in large part are not occupied. I don't know that we're going to see office occupancy regain its pre-pandemic vacancy level. The same would go for hotels in urban centers because of a lack of business travel. So there has to be a knock-on trickle-down effect at some point to urban multifamily that's continued to be under construction. So everything's related right now. If we do have, let's say, 20% of workers or 15% of workers who are of means work from home forever, that'll make a big difference in terms of the dynamism in both commercial and residential real estate.
Yeah, such a good point. And, one of the things that's hard to get your mind around is because of the general length of leases in commercial and office, that those decisions are made at a period of time, and you've got a big amount of, square footage that you're committing to for 5 years or 10 years and with options and the like. Whereas the other extreme is the hotel business, which is mostly transitory, meaning I'm going to come in for a conference or convention for a few days. And yet I think people have figured out that we can get maybe 80 or 90% of that work done without physically going somewhere. Yet I've been flying around a lot and virtually every flight full. Resort and vacation travel seems to be good. And you drew out that distinction last time we talked, and you kind of made the prediction, I'll say, that, I'm not sure business travel is going to come back, but it seems like personal travel is. What have you been seeing there?
Well, this is an outgrowth of my former employer's policies. So the rich have gotten a lot richer. So we have seen hotel rates at the highest end luxury hotels during weekend rates they're in a different zip code compared to weekday rates. I won't name the luxury resort, but there's a resort out in California that's gone from basically the highest end room has gone from $2,800 a night to $5,000 a night on the weekends. And they're getting the money for it because this wealth effect, for individuals who've been on the receiving end of Fed policy, who have big risky asset portfolios, they're starting to see how vulnerable they are. And I'm sure they're getting a little nervous. We're actually seeing with the University of Michigan consumer sentiment data, we're seeing the largest amount of declining sentiment among households making the most. So it's clear that there's a lot of nervousness around the volatility in the stock market. In other words, up days are making people just as nervous as down days because the swings are so massive. So, but at the moment, high-end leisure travel is on fire.
Our guest today is the amazing Danielle DiMartino Booth. We'll have more to ask Danielle, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from August 26th to 29th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful. And wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown, and with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and real estate contracts are in English. And at Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me in August in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on events where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, August 26th to 29th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under events, and I look forward to seeing you in beautiful Belize.
Hi, this is Peter Schiff, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show today. If you want to see an awesome real estate market, make plans to join the Real Estate Guys as we head back to Jacksonville, Florida in August. You can get yourself on the advance notice list if you go to realestateguysradio.com and click where it says events, where you'll see the Jacksonville field trip. It's a great market. We'll have an awesome time. It's our series, The Road Ahead. Today we're talking with Danielle DiMartino Booth. Before we get back to that interview, let's play Real Estate Trivia. Your chance to win a prize by knowing something about real estate. In just a minute, I'll give you a question. When you come up with the answer, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. The first person that gets the right answer gets an awesome book called Bringing Value, Solving Problems, and Leaving a Legacy. It's a collection of awesome stories. You're going to dig it. That could be yours if you know today's real estate trivia question. Last week with Adam Taggart, we asked this: which country has the population with the highest IQ? Well, the answer is Japan. Yep, on average, the Japanese are the smartest folks on the planet. Here's our real estate trivia question for this week. Which U.S. state has the most registered motor vehicles? Car sales is something Danielle looks at. Well, which state has the most vehicles registered? If you know, or just want to take a guess, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. Include your name, your mailing address, and the answer to the question. If you're the first person that gets it right, you get this awesome book, Bringing Value, Solving Problems, and Leaving a Legacy. That's today's real estate trivia question. Our guest is Danielle DiMartino Booth. She spent 9 years with the Dallas Federal Reserve, and it's great having you with us, Danielle. Now, let's talk a minute about the differences now when it comes to people buying real estate than we saw, back in 2006, 7, and 8, it didn't take much to qualify for a mortgage, and that was a whole debacle. But it seems to me that the people that actually are in contract to buy properties, whether those are investors or homeowners, they're qualified. They have jobs. They have the ability to put 20% down. Does that make that any different as the market starts to retreat a little bit?
We can hope that there's a difference made, but we're definitely seeing with record numbers of workers in the mortgage industry, we're definitely seeing that credit box open up. We're seeing lower FICO scores. They've got to be able to justify the number of warm bodies they've got on the mortgage side of the business. So it's really hard to say, especially because underneath all of this, you have this runaway inflation that makes an inflation-adjusted wages. It's a great narrative to talk about how much salaries and incomes are growing. But once you throw against that the fact that the CPI, the consumer price index, is growing even faster, you're like, oh, well, wait, we thought we were getting ahead, but we're not.
It almost seems to be the other way around. As prices go up, employers are raising wages a little, but certainly not enough. I mean, we look at this in multifamily, that an increase in, say, gasoline and food prices, whether that's part of the CPI is another discussion, but when that happens to tenants, it makes a big difference in their lifestyle. They'll make decisions to come down $100 in rent, which with rents going up might be coming down, a couple of chains in the fence in terms of their accommodations. But it really does affect them at that level. The day-to-day tenant that gets up and goes to work, they're seeing it probably worse than the 7.5% that we're all hearing in the news.
They are, because as a percentage of their income, essentials cost so much more. And, with all this buzz about the Ukraine and as high as gas prices have been, they're within spitting distance of being kind of $4 a gallon nationwide. And again, we've become all over again a nation of people behind the wheel. So everybody bought all those cars and now they have to maintain them and fill up the gas tanks. They're not jumping on the subway in the morning. They're not Ubering everywhere anymore. So there are so many different offsetting factors right now that, again, I think that it is incredibly difficult to tease out the trends at the beginning of this year. What we can report is that overall consumer confidence, consumer expectations especially, are already in recessionary territory. We've never seen, that's not true. There was the early 1980s double dip recession. That was the last time in history that we have seen anything move this fast in terms of the U.S. household going from euphoria to the opposite end of the spectrum. And it's just been remarkable to see. The same can be said for the compression of the yield curve. The difference between the 2-year Treasury and the 10-year Treasury is now south of 50 basis points. That suggests to you that Federal Reserve policymakers, they don't have all that ammunition in the chamber that the sell side on Wall Street seems to think they do. They can talk a big game. Yeah, the Fed's going to raise interest rates 7 times this year. I'm like, well, the yield curve begs to differ. So let me know when you two resolve that.
Well, I'm sure there was an over and under on how soon we'd be talking about the Federal Reserve, given your background, but figured we better go there, right? They keep saying that. And of course, our mutual friend, Peter Schiff, is saying they just can't do it. There's just no way. What are your thoughts on how they temper between being able to save face in the market, do what they need to do, and yet not implode the whole thing?
It's some part of me is almost as cynical as Peter. So that's saying something. Because the Fed is going to start seeing multiplying levels of evidence that the economy is slowing.
Yep.
So, the cynic in me who spent 9 years inside the Fed is like, maybe they're just trying to wait this out. Maybe they feel like if they get to March 16th, they're going to be able to say, you know what, we see enough evidence and we're data dependent. We never said that we were not going to be data dependent. We see enough evidence, to just do that 1/4 point hike on March the 16th. Maybe. It depends, because it's a dog year between now and March 16th. And the data are moving faster than the Fed is. I, for one, applauded Jim Bullard in coming out and saying that it was appropriate, given that inflation was off the rails and accelerating. It was absolutely appropriate for the Fed to do an intermeeting rate hike. And when it was 911 before, when the pandemic first hit, they had all kinds of emergency meetings in order to get the data under control. And now that you've got the most regressive of all taxes, they appear to be deer in the headlights. So, the hypocrisy runs deep, and the whole world was waiting on Monday morning to see if Jim Bullard was going to come out and refute what he had said. And you know what? He didn't. So, and that's another interesting development at the Fed is to see the lieutenants not fall in line, and for there to be disparate views. And, you can tell, for sure, Jay Powell picked up the phone and said, Jim, you got to walk this back.
Right.
And I think Jim said no.
Yeah.
And good for him.
Well, and obviously there's a lot more that goes into what the Fed decides to do to how interest rates hit on the street. Our listeners are interested in, are they going to be able to get loans for property, and are they going to be able to refinance? And everyone sees an uptick in retail rates, but still, big term perspective, rates are still very, very low. The fuel we use to buy investment property are mortgages, and they're available, they're affordable. And do you see anything changing drastically there?
Look, I mean, I really do think that once you get north of 2% on the 10-year and you stay there, I think things start to break.
Yeah.
It seems like such a ridiculous thing to say. It's almost embarrassing. But the fact is, every time the Fed has had to come in and rescue, they've started from a lower ceiling in terms of where rates are when they try to start endeavoring to tighten. So on the commercial side, I think that the ability to secure financing is going to be a little bit easier than what it is on the mortgage side because home prices are at nosebleed levels. We've gone from effectively, Fannie, we've gone from 2.6, call it at the bottom, December 2020 to 3.7. When you consider the base was 2.6, 1.1%, that's quite the delta.
That is.
But you would hope to think that commercial real estate was not that interest rate sensitive because historically speaking, borrowing rates are as low as they are. But again, these last few months, I have been hearing about multifamily apartment buildings trading at most recently a 2.4% cap rate. I'm like, that is tight as a drum financing. Nothing can go wrong. Interest rates cannot go up. Rents cannot go down. Occupancy has to stay 100%. I mean, everything has to go perfectly right when a deal is underwritten in that manner.
Well, I'll tell you, we see so many folks at our events and at the other events. I just spoke at a multifamily event over the weekend, and you've got the brand new, I've invested in single family homes and now I'm going to go buy an apartment building, folks. And then you've got institutional money. Everybody's chasing it. Cap rates continue to compress. And yet you're right. There's so little margin for error. And your underwriting has to be really, really good. And what's made it even harder is the incredible changes we've been through, right? If all my tenants worked at restaurants and gyms back at the start of COVID, I was in serious trouble. So now we're taking a look at tenant mix and thinking about things like master leases, and it's a lot. And, at the same time, we are negative on needing housing units, and we're seeing record housing starts and apartment starts. And it's fascinating to watch, isn't it?
It is, but I would, if there's one thing that I would caution your listeners about, it's the underlying faultiness, with due deference to the National Association of Realtors estimates for the home deficit. They're only looking at the size of the U.S. population. And I would have been booted out of business school had I only looked at the stock as opposed to the growth rate. And when you take the growth rate of the population into account, which last year was negative, by the way, because so many people did die. So when you take the growth rate of the U.S. economy and you factor that into your calculus, the NAR 6.8 million home deficit figure gets a lot closer to 1 million, a lot closer.
And then you talk about people out of the workforce and all of that. So that is a gold nugget. I knew you'd have at least one for us. Good stuff. Hey, before we let you out of here, Danielle, anything else that you're looking at that our listeners should be thinking about? Any of those unique perspectives of yours?
So I think it's fair to say that you should pay very, very close attention to the midterm elections. We're ingrained as Americans that every single time the economy gets into trouble, that either the Fed or the fiscal authorities, somebody's going to come to the rescue. So we've been taught this, but this midterm election season, I think, is going to be so contentious that neither the Fed nor fiscal authorities might be coming to the rescue. And that's a different dynamic than we've grown accustomed to. So my theme when we were both in New Orleans was politics is economics. That really hasn't changed.
All right. Good stuff as always. Hey, if you're impressed with all of the intelligence Danielle shares with us, and you should be, she does this on a very regular basis, and she's got a couple of great subscription services. To learn more about that and to receive a very special Real Estate Guys discount, we appreciate that, Danielle. All you're going to do is send an email to Quill, Quill, that's her company, Quill Intelligence, Quill at realestateguysradio.com, and we'll instantly point you to the great work she does. Danielle, always great to have you on the program. Thanks for your wisdom and your intelligence.
Thank you. I appreciate your time.
There's Danielle DiMartino Booth. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, I'm G. Edward Griffin, author of The Creature from Jekyll Island, a second look at the Federal Reserve. And you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, if you've ever wanted to have more influence, have a bigger position in people's life, or even just get good at selling, you ought to mark your calendars and come out to How to Win Funds and Influence People. It's our sales workshop that happens once a year. Russell Gray does a magnificent job of teaching you not just the techniques, but the principles behind belly-to-belly consultative selling. It's an amazing event. Get all the details on our website at realestateguysradio.com under the tab that says events. Well, my oh my, what a pistol Danielle DiMartino Booth is.
She is. She's so prolific. You know, if you are a consumer of financial news, as I am, she just shows up everywhere. I'm amazed the woman even sleeps, and much less has any time to do any research or any writing. She's just on all the time. Obviously, people value her opinion. She gets invited on to show after show after show after show because she's so articulate. She's so witty. She is so brilliant and experienced. And she kind of puts the pieces of the puzzle together. You know, as real estate investors, of course, we wanted her take on real estate. It was interesting to hear her talk about how investor participation in housing is up. I pay a lot of attention to what's going on Wall Street, not because I'm a fan, but actually because I'm not. And the mission I've always wanted to be a part of, and what we do through our syndication program, is helping Main Street investors get their money out of Wall Street and have it invested directly into Main Street investing in Main Street. It's what our syndication training is all about. People buying real estate, buying apartment buildings, you know, doing development projects, buying agriculture, whatever it is, getting into real assets. But it's interesting that big money, Wall Street money, now is beginning to pursue that as well. I saw an article the other day that talked about Blackstone taking a multi-billion-dollar chunk of multifamily real estate down. And of course, this is at a time where cap rates are at all-time low, but it's still attracting gobs of capital. You know, this is telling you that big money is sensing something and they're making a move into real estate.
Right. And Danielle specifically said it's tight as a drum when you're buying at a 2.5 cap. Ow. Now, if you don't understand all that, well, there's lots of resources to learn how we value properties and why. But I think the big picture is just different investments find favor with different groups of people at different times. We have always been proponents of the mom and pop, Main Street, investing in Main Street, as opposed to taking your dollars mindlessly to the casino called Wall Street, where people who earn millions of dollars a year take it and maybe make a return, and most of it goes to them. This is not for you. Real estate is arguably the single best place to not only preserve your wealth, but to make more of it, which is why we're such big fans. And why, you know, listening to Danielle, she looks at it not from the perspective of a real estate syndicator, but more as an economist. And when she sees these big picture moves, which she calls to our attention, it is super helpful.
Absolutely. And she watches not only the movement of the money, but really what's going on demographically. So she has some really good comments. She talked about how she's seeing an increase in renting to roommates. In other words, people trying to find a way to make ends meet in the midst of this inflationary environment where housing and rents are going up faster than wages. And so you've got people that are either not able to get in on the housing market at all. It's running away from them. And certainly in our lifetimes, Robert, we've been through cycles like that where you just got to kind of run and catch a train by your fingernails and hold on and trust that 10 years from now, the house will be worth considerably more, even though it's very difficult to get your foot in the door in the beginning. And for some people, it's almost impossible.
Well, to that point, Russ, I think a great house hack, a thing somebody can do today, you have the millennials, the people she was talking about. Imagine a scenario where you buy a 4 or 5 bedroom house, and rather than raise your family there when you're young and unattached, you find 3 or 4 roommates. I had a buddy in college who didn't buy a house. He rented a house. It was 4 bedrooms. He stayed in the master suite. He rented the other 3 bedrooms or sublet those other 3 bedrooms out. And for the rent he got for those 3 bedrooms, it covered almost the entire cost of renting the house. So imagine that where you're actually building equity. And I think the traditional way people approach real estate has changed a bit, and today's consumer is not the consumer we were used to growing up. So there's lots of different ways to attack this. And I think the fact that people are looking at these alternatives, roommates, I could rent an apartment and get a roommate. That's one way to make it more affordable. But what if I got a bunch of roommates and they made my mortgage payment?
Yeah, well, and there's a dynamic, too, that is occurring because you've got several things kind of all converging to create some opportunity. You've got relatively low interest rates. You have rising home prices. And so the low interest rates really aren't allowing people to participate because cost of living is going up and the prices are going up. And yet you've got the opportunity, I think, right now for something to come back that you and your dad were involved in way back when, but equity sharing. And it's kind of syndication 101. If you really think about it, syndicating is just a matter of partnering with someone else to do a deal bigger than you could do on your own. Well, if you think about the young kids who are just starting out in life and they borrow a down payment from mom and dad, maybe mom and dad gift them the money, but in some cases, mom and dad could co-invest. We'll make the down payment, you get the loan, and we'll share. And somewhere 5 years down the road, we'll refinance or split the property and one of us will buy the other out. And you've gotten a chance to participate on the right end of inflation instead of the wrong end of inflation. I think there's a big opportunity to do that right now. I think young people are looking for that kind of help. I think that the marketplace is going to create those opportunities, to your point, Robert, where you did that on maybe a bigger property than anybody needed, and you add roommates into the mix to help make the payment. All of a sudden, now you're participating in the market at a time where people are being priced out. So maybe there's a little bit less competition because the pricing is not necessarily based just on a lot of competition. It's based on an undersupply of inventory. And Danielle also talked about that, but I know you and your dad helped people do that quite some time ago, and it was a very successful way to help people get into houses.
Well, what was interesting about that period of time is back before there were the liar loans and all that stuff happened with the, availability of credit that you could say either caused or exacerbated the 2008 debacle. But what happened is we were selling real estate in Northern California, in the Bay Area, where prices were very high. And so for a young working couple, saving up 20% down was difficult. And you had to have 20% down, occasionally 10%, but there were no 0% loans or any of that. Maybe you could assume an old FHA loan, but still, to bridge the gap to the price was a lot of money. So we started empowering these young couples primarily to go out and find someone in their life that could help them with the down payment, not as a gift necessarily, but as an investment. And so the idea of equity sharing is one party puts up the down payment, the other party qualifies for the loan and makes the payments, and then they split the equity going forward. Typically, the occupant, the person who stays in the house, would have the first right of refusal to buy the house at the end of some period, say 5 years, when maybe it's gone up and they can refinance it and now stand on their own 2 feet. But I actually did that a whole bunch of times as just an investor in investment property. We had folks that were interested in buying duplexes and fourplexes and single family houses and had good income and had time and had, developing expertise as they got educated. They just had that big stumbling block of down payment. And my favorite thing to do back then would be supply the down payment, and they supply all the hard work. I'd look over their shoulder, I'd give them some input, and then voila, we'd split the return. And those returns were significant. Today, when we're seeing the squeeze on pricing and the like, what is still clear is that people need a roof over their heads. And so if you can approach an investment in a different way, which is what equity sharing is about, I think it can make a lot of sense. There's more there. We probably end up doing a show on the latest when it comes to financing and so forth, because, when you have what the lender calls non-related co-borrowers, it just looks different, but it is possible. And I think maybe we get Stephanie Riley back on the program, because I know she specializes in finding a lot of unique financing for these kinds of deals.
Yeah, it's going to be great. As I said, I just think that the market conditions are ripe for it. There's equity out there that can be repositioned from property A to down payment in property B, so the investor really doesn't have to put a lot of cash up, maybe just take on a little bit of a payment. Sometimes the income or the tax breaks from the deal can help cover that, so we can get into the weeds of all that when we do that show. But coming back to Danielle, one of the things that she said that I also thought was really interesting, I alluded to earlier, was the faultiness of NAR's home deficit numbers. And she's saying, hey, NAR is claiming that we're short nearly 7 million houses compared to what we need. And she's saying, hey, that's probably more like 1 million based on the population growth rate being slow to negative. And Robert, you called that out as a gold nugget, and I thought it was very, very insightful, because you go back to this idea of, hey, where a price is headed, and if we're not as short as everybody thinks they are, then it may mean that we are not as overinflated as everybody thinks we are, because the shortage isn't as big, the deficit isn't as big. And so I know there's some people out there who are considered, hey, I think that we're in a real estate bubble. And I guess you could make that argument from a nominal perspective, but we haven't seen this kind of inflation in 40 years. So it's hard to compare this real estate market to any market that we've seen in the last 40 years. Because wages are also going up. Yes, they're not going up as fast as the cost of living. Whether those things that are affecting the cost of living are going to be corrected with supply chain solutions. Because think about that. You raise wages because current pricing forces it. And all of a sudden now the cost of living actually starts to go down a little bit because the supply chain works itself out. Now you've got kind of a bullish environment. So again, I'm not saying what the answer is. I'm saying it's fun to get in these conversations. I mean, I had a chance, as you know, Robert, to sit on a panel with Danielle and Jim Rickards and John Najarian, three very smart people. And we banter back and forth. And of course, I was low man on the totem pole, just happy to be on there, but at the New Orleans Investment Conference. But this is what you got to do. You got to get in these conversations with these smart people and just let people talk. And so this whole series with Road Ahead is about bringing those voices to our listeners so that you guys get a chance to hear what these people are thinking. You have to draw your own conclusions and maybe listen to the show and talk about it with some other friends and banter your ideas back and forth.
Well, it's such a good point that there is no one person that knows it all, gets it exactly right every time. NAR says it's this number. Danielle thinks the number's less. Maybe there's a middle position. Either way, I think it's incumbent upon all of us to vote with our dollars based on what we see, and the more you see, the better. Hey, if you'd like to watch that panel, and I can't imagine why you wouldn't, we mentioned it last week because we had Adam Taggart on the program. He moderated that panel. John Najarian talked about cryptocurrency. Jim Rickards, of course, one of the smartest guys around, Danielle, and our own Russell Gray. We'll include a link so you can watch that entire thing, which you'll want to. When you reach out to learn more about Danielle and Quill Intelligence, all you have to do for all that is send an email to quill@realestateguysradio.com. Next week, we wrap up the road ahead with our final guest. I think you're going to dig it. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.